Today, we're going to crack open one of the most important books ever written on investing. We're going to pull out a single, incredibly powerful lesson that's been true for almost 100 years. It's the kind of lesson that really separates the amateurs from the truly intelligent investors. So let's just start with a simple question. Picture this. You find a fantastic company, it's innovative, customers love it, it's just crushing the competition. Buying its stock is a total no-brainer, right? Well, what if I told you that exact line of thinking is one of the biggest and most expensive traps on Wall Street? Seriously. The answer to that question is really the key to protecting yourself and thinking like a truly smart investor. Yeah, this whole thing has a name. It's called the quality stock trap. And believe me, it's a powerful misconception that even really savvy people fall for all the time. The trap is this assumption we all have that a great business automatically equals a great investment. But the legendary Benjamin Graham, we're talking the father of value investing here, he argued this belief is actually incredibly dangerous. He saw it again and again, investors paying way too much for quality and ending up with mediocre or sometimes just disastrous results. So, how do we avoid falling into that trap? Well, it all starts with understanding Graham's most fundamental idea, the absolutely critical difference between price and value. And here it is. This is the whole thing in a nutshell. Quality does not equal value. Just let that sink in for a second. A company can be absolutely phenomenal, a real game changer, but it's the price you pay for its stock that determines whether it's a good investment. They are two completely separate ideas. And to make this crystal clear, Graham didn't just spin theories. In his book, he laid out a really practical case study comparing 4 actual companies. Let's take a look at how he broke it down. So what Graham did was compare 4 different kinds of stocks. On one end, you've got this expensive blue chip that everybody loves and can't get enough of. Then, moving across, you see a quality company that's more fairly priced, a cheaper secondary company, and then finally, a true value bargain that pretty much nobody was paying attention to. And what's so important here is that Graham totally ignored the hype. He didn't care about the exciting stories or how popular a company was with the media. Nope. His entire focus was on objective, verifiable data. The cold, hard numbers that tell the real story. And these numbers illustrate his method perfectly. Just look at the PE ratio. See that expensive blue chip on the left? It's trading at 20 times its earnings. But as you move to the right, the price gets cheaper and cheaper, all the way down to just 5.6 for the value bargain. And then look at the dividend yield. It's the complete opposite. It goes from a tiny 2.5% all the way up to an attractive 7%. Graham's whole point was that this is where the real opportunity is hiding. Okay, so what exactly was he looking for in all those numbers? Well, Graham used a simple but incredibly powerful 5-point toolkit to analyze any business. This is basically his checklist. First, PE ratio. Is the price you're paying actually reasonable for what the company earns? Second, dividend yield. How much cash is this thing actually going to pay you? Third, book value, which is basically what are the company's hard assets worth if you had to sell everything? Fourth, financial strength. Could it survive a really bad recession? And finally, management. Are the people in charge actually good at managing your money? Now, all 5 of those points, they all lead to one master concept. And this might be the single most important principle in all of investing, creating your margin of safety. So what is it? Put simply, the margin of safety is the gap between what a company is truly worth, its real intrinsic value, and the price you actually pay for it. The goal isn't just to pay a fair price, it's to have the patience to wait until you can buy it for a whole lot less. And this is why that buffer, that cushion, is so critical. If you buy that expensive stock right at the top, you have 0 room for error. Anything goes wrong and you lose money. But look at the bargain stock down at the bottom. The price you pay is way below what it's actually worth. That huge green area, that's your margin of safety. That's your financial shock absorber. And the benefits of having that wide margin are just immense. It protects you if your own analysis is a little off, which, let's be honest, it happens. It protects you from just plain bad luck. It gives you massive upside potential for when the market finally wakes up and sees the true value. And maybe just as importantly, it gives you psychological comfort so you can actually sleep at night when the market is crashing. Now, you might be thinking, okay, this all sounds a little old-fashioned. But here's the thing.
The real beauty of this framework is that it's timeless. These principles are just as powerful today as they were decades and decades ago.
I mean, just think about the dot-com bubble. People were paying over 100 times earnings for internet stocks that had no profits, all based on hype and a story. Graham's 5-point toolkit would have been screaming danger on every single one of them. It's a timeless defense against these kinds of speculative manias. And this all leads to a really powerful, kind of counterintuitive idea. The best investment opportunities are often, well, they're boring. They're the unglamorous, overlooked companies that nobody is talking about. That very unpopularity is what creates the discount in the first place. It's what gives you your margin of safety. Okay, so let's tie this all together into 5 key takeaways. First, you have to remember price is what you pay, value is what you get. Second, even a great company becomes a terrible investment if you overpay. That's why, third, you must always insist on a margin of safety. Fourth, this whole thing requires a disciplined system because that's what beats emotional guesswork. And finally, that discipline will often lead you to what's unpopular because that's where the true value is so often hiding. And that really just leaves us with one final question for you to think about. The next time a stock is flying high and everyone is excited about it, will you have the discipline to step back, to run the numbers, and to wait for a true bargain? Because the answer to that question, that will define your success as an intelligent investor.